Equity crowdfunding is a way for everyday people to invest in startups, and the amount of money that has been flowing into this space is massive. Last year, $214 million was invested in startups through equity crowdfunding. In 2021, we blew past that figure in June. To truly understand what equity crowdfunding is, we have to understand what existed before equity crowdfunding. When you are starting a company, you need money. The most obvious option is to ask a bank for a loan. However, banks view startups as risky and oftentimes reject the request to loan out money. In this scenario, you would turn to either angel investors,
rich people,
or venture capital firms. There's a couple of problems with this though. For starters, geography plays a major role in your ability to secure funding from angel investors and venture capital firms. California, Massachusetts, and New York make up 73% of all venture funding in the US. That leaves a lot of geographies uncovered.
Oh, this is some bullshit.
It can be a lot of work to court these venture capitalists, which can take away time from building out the actual company. And lastly, when you go the route of equity crowdfunding, you don't always get the best deal terms. There's room for negotiation, and you may end up with a deal that's less optimal than what you went in with. With equity crowdfunding, founders get to set their terms, and equity crowdfunding investors then either accept or pass on the opportunity. So those were the options that founders had. Banks that would oftentimes say no, angel investors if you were lucky enough to personally know some of them, and then venture capital firms where you might not walk away with the best deal and you have to expend a lot of time trying to court them. Then came the 2016 Jobs Act. This changed everything. Everything. Up until that point, people needed to qualify as an accredited investor in order to invest in startups. However, 97% of the US population does not qualify as an accredited investor due to its high standards of income and wealth. The 2016 Jobs Act enabled non-accredited investors to invest in private companies, and this opened the floodgates to what would become known as equity crowdfunding. Ordinary people paying a select amount of money to receive equity or future equity in a company. Let's take this new startup, we'll call them Baby Google, and Baby Google is not going to benefit from one individual investing a couple $100s in their company. But thousands of people investing a couple $100s into Baby Google, now that becomes a powerful funding option. So following the 2016 Jobs Act, tons of equity crowdfunding platforms cropped up. Instead of each startup personally sourcing investors and receiving money from them, these platforms curate an entire community of investors and then bring investment options to them. These equity crowdfunding platforms provide value to both startups and investors. For startups, they provide access to hundreds of thousands of investors actively looking for their next deal, so essentially access to capital. For investors, they provide a secure way to invest in reputable startups. In addition to secure payment facilitation, these equity crowdfunding platforms also vet the startups and can be very selective. Republic, one of the leading equity crowdfunding platforms, accepts less than 5% of all startups that apply to be hosted on the platform. The barriers to entry are also very low for everyday investors. Most platforms require just $100 to invest. However, each company that raises has the option to raise that minimum threshold. Many companies also offer fun perks based on your investment size. This could be company merch, free company products, free company face tattoos, or even unique experiences like dinner with the founders. There used to be 20 plus equity crowdfunding platforms. However, the market has really consolidated over the past couple of years to just 3 to 4 major players. I'll be releasing a later video that dives into each equity crowdfunding platform and evaluates how they're different, what their nuances are. So if you want to see that, please hit subscribe so that you get notified when it comes out. Okay, I imagine the majority of people watching this video are potential investors, so I want to spend some time letting you know how you can make a return. It all depends on how the exact offering is structured, but most startups are offering equity or future equity in their company at a certain valuation. As an investor, you want to select companies that will grow past that valuation and get to a point where they can conduct an exit. Until this happens though, the value of your investment stays the same and it is illiquid, meaning you cannot access it. Investing in startups is a very patient game. You should not expect to receive a return until numerous years have gone by and the startup has grown into a bigger company. So just be prepared to be patient with this. However, if and when an exit is conducted, this could be an extremely profitable event. The equity crowdfunding space is moving so quickly and there are a lot of really great opportunities out there. At Crowdscale, we hand select the best of the best opportunities and share them with our subscribers. But not only that, we also share a rationale behind why we think certain investments are great. If this is content that interests you and you would like to see, please hit subscribe.